Greetings, everyone. In the interest of time, I want to be respectful. It is the top of the hour, so we are going to get started. My name is Kristen Kolish. I'm a retirement plan consultant with Raymond James. I work with a team of professionals to help employers and employees navigate their corporate retirement plans. So, as part of my role, I speak often on various topics of interest, ranging from fiduciary training, cybersecurity, service provider evaluation to employee education. I did a program earlier this week with an expert on Social Security. And at the end of the day, it's all about getting smarter and trying to take what is best in class and the trends and bring it back to your organization. And that's why I'm so excited about today's topic. It really is on the cutting edge of retirement plan trends. I know in over 20 years of working with retirement committees, usually the members of retirement committee are HR and finance. And sometimes their interests are different and sometimes they're aligned. And retirement income seems to be something that everyone is talking about and everyone is interested in. So let me start with some housekeeping items and then we'll dive into the content. This session is being recorded, so feel free to share. It'll take me about a week to get it approved by my compliance team. I will get out to you this afternoon a copy of the slides, so don't feel like you have to take copious notes. There's a handful of slides that I'm going to point out that would be a good reference point if you want to continue this conversation internally. And then I'll also, for those who are interested in SHRM PDC credit, if you stay on this call for at least 50 minutes, I'll include the SHRM PDC code in that email. So by way of background, and really thinking about what is on the docket for us for the next hour or so, I'm going to be covering a wide range of topics, but it's really, I'd say, split into three sections. First, we're going to talk about the evolution of retirement plans in the United States. And in a lot of ways, today's topic, retirement income, is almost a back to the future concept, right? Because it's all started with traditional pension plans, which by its very definition is retirement income. Then we're going to talk about understanding what employees are looking for, what they need. And then lastly, I'm going to give you, and this is the dense section, a primer on retirement income options. So you might be thinking to yourself, retirement income, what on earth is she talking about? It could be something as simple as educating your employees about what income means and how to translate their 401k balance into a paycheck in retirement. But there's more research and product generation that there's actually investment vehicles that help do that for you. And you might have heard of the word annuity. Usually, over the course of my investing career and my team's investing career, annuities has been traditionally marketed to individuals. And if I'm being completely honest, it's a word that to me has a negative connotation because I associate annuities with expensive products. And I'd say more often than not, when I meet someone who has invested in an annuity, they don't understand it. They don't understand why. Even myself, if I'm going to analyze an annuity investment, and I do this for a living, it'll take me 10, 15 minutes to get through a statement and understand all of the features. So how do we get the concept of an annuity, which is all about lifetime income, and translate that into something that is understandable? And that's really the conundrum that the retirement industry and plan sponsors are facing today. Let me start with a question that was posed in a Nuveen survey last year. A group of participants was asked the question, if you had $500,000 in your retirement account, what percentage could you spend each year during retirement without running out of money for the rest of your life? Okay, if we are in live and in the flesh, I'd ask you to take your own guess, but I would hope that your answers would be a little bit more in line with reality than what Nuveen found. 48% thought they could withdraw 7% or more annually a year, and 33% they could withdraw 10% or more. Now, think about it. A 401k plan or a 403b, for most American workers, by the time they retire, this is the most amount of money they've seen in one account. So they might feel rich. Maybe they have $1 million in their 401k or 403b. And wow, I'm a millionaire. Well, it's really hard to retire on anything less than that if you're living for any length of time. So I am now going to dive into the material, and I'm going actually to take myself off a video so you can focus on the slides. Setting the stage for retirement income. I mentioned before using the phrase back to the future. Retirement income started with defined benefit plans, and that goes back to the mid-1900s. Employers offered plans where they would promise an income stream in retirement. Now, let me remind you that at the time, retirement was not a 25 or 30-year proposition. People worked longer as they worked manual labor, and they worked until they couldn't anymore. And oftentimes they didn't live much longer than retirement. And last year, we actually celebrated the 50th anniversary of the Employee Retirement Income Security Act, or ERISA. And that is the law that governs all qualified plans. Now, that was passed because of crises in the pension space. There were plans, pension plans, that were going bankrupt because of the lack of planning and funding without federal government regulation. As a matter of fact, Studebaker Car Company was the largest pension bankruptcy, and it left retirees without any promise of, they had a promise of income, and they retired with nothing more than Social Security. So the federal government stepped in and said, you know what, we need some safeguards here. And that's where ERISA started. Now, 401k plans were actually, believe it or not the well thought out investment savings vehicle that we might think about today. It was really a loophole in the tax code that allowed for tax deferred savings. So the first 401k plans began in the late 1970s. But for most of the 50 years in the mid 1900s through 1980 and even into 1990, I would call this the defined benefit era. This was, and the good things about it was that retirees had a guaranteed lifetime income. You started at a company after you left school, you stayed there for decades at a time, you retired, you got the proverbial gold watch and a pension check. It was clear, it was easy to understand, you knew how much money you would have in retirement. That, coupled with Social Security, that was your budget. That's what you had to live off of. Now, the bad part about that structure is that the benefits were not portable, meaning if you were to change employers, you could be missing out. And back then, it was much more common for someone, a worker, to stay at a company for an extended period of time. It also benefited a relatively small number of people. Really, to maximize your benefit, you had to stay there for that extended period. So in walks the modern 401k era, which is really what I'd say that we were in today. Today we actually have some bells and whistles. So there's a third time period that we're going to talk about here. But in the 1983, 1984, the Retirement Equity Act started really focusing more on 401k plans. And we passed $1 trillion in 401k plan assets in the mid 1990s. So that's nearly 20 years after the first 401k. An added tidbit, just last year, we actually passed $1 trillion in target retirement date funds within 401ks. So the market has increased exponentially. The first HSA was created in the mid 2000s, and then 2006, from my perspective, was one of the most significant pieces of retirement plan legislation in my lifetime, because it really gave a green light to plan design changes such as automatic enrollment, qualified default investment alternatives. Prior to 2006, sponsors viewed the 401k as an option for employees to opt into, but nothing more. And really, as we've discovered, as pension plans have become, one, very expensive for private companies to offer, but two, the mobility of today's workforce, the pension plan calculation may not benefit you. Oftentimes today's workers are changing jobs, and in that environment, the portability of a 401k is certainly very important. In my experience, today's retirement committees are more proactive about nudging their employees to make positive decisions. And oftentimes, plan design is a great way to do that. As a matter of fact, as of today, nearly 2/3 of American workers have access to an employer-sponsored savings plan. And that's up in the last 5 to 10 years by more than 10%. As a matter of fact, as we move to the Secure Act age, this has now become a mandate. But let me pause for a second and just recap. This modern 401k era, there's a lot of good things that are associated with it. It's encouraging investing at an early time. And I'm actually hosting a webinar next week geared towards those who are just starting out in the workforce. And honestly, I view that as an absolute gift, the gift of time. The earlier you can start saving, you're definitely setting yourself up for an easier and smoother path to retirement. This offers that portability I talked about, allows you to make your own individual investment decisions and portfolio decisions, perhaps taking more risk with more opportunity for growth. And it's pretty straightforward. These are the assets that you have available to you. And I think as an industry and as employers, we've done a really good job getting employees to accumulate assets. So one, access to plans. Yes, I just mentioned the progress we've made. The second, plan design is so important, nudging employees in the right direction. According to a study that Fidelity conducted last year, plans that offer automatic enrollment have participation rates that are nearly 2 times that of employee or plans where automatic enrollment is not initiated. And that's assuming there's no employer contribution. So auto options, access, and we've really improved education. One of the themes that I keep hearing over and over and over again, I mentioned SHRM at the beginning of the conversation that we offer PDC credits. Raymond James and the Society for Human Resource Management collaborates on some retirement planning initiatives. And as part of that, we keep hearing about the interest in helping employees with their financial plans, regardless of whether or not retirement is the number one goal or not. Like this idea of financial wellness, and I know that that's a phrase, if you're in the HR industry, that's a phrase that can be completely overdone, and you might be asking, what exactly does that mean? To me, it means that employees are expecting more from their employer. Employees want help making progress on their personal financial journeys. It's not just offering a 401k, it's giving them an avenue to learn about, how do I decide how much to save in a 401k versus paying down student loan debt versus managing, maybe you're the sandwich generation, you're managing caregiving for parents and for children. Our financial lives are complicated, and they've always been complicated. I'd say the most notable difference in my career from when I started over 20 years ago to today is that earlier, financial was a topic that was private. Like I'm not talking to my employer about my finances. I'm not talking to my colleagues about my finances. And I think what's happened is that our financial future is so dependent on the benefits that you all offer your employees. It's so important that really, to get the full effect of those benefits, you really need to lean in and use all the tools and resources that can be offered through you as the employer. Now, of course, we're not having individuals share with other HR professionals their specifics, but offering avenues to provide an opportunity to have a one-on-one conversation or use a retirement income projection, something that's more all-encompassing. And of course, a 401k plan does not give you a guaranteed income source. So think about this. You save all your working years, you get to retirement, you have a pool of money, and it's like, okay, how do I generate an income stream from this? I like to think about, how are we giving retirees a paycheck? And that could be done individually, just through portfolio management and withdrawing from the portfolio systematically, or as today's conversation is going to cover, there are products that can help us to do that in a more thoughtful and specific way. So let's think about why is now the time for retirement income? Well, there is participant demand for sure. Over 85% or near 86% of those surveyed in an Allianz State of Lifetime Income report, it literally came out a couple months ago, are looking for steady income in retirement. And then also, when I think about retirees keeping money in the plan, 75% would prefer to do exactly that. And that's up from 50% 10 years ago. So think about that. 10 years ago, nearly half of employees, when they retired, they took their money with them. Now we've got 3/4 of employees letting the money sit in their plan, at least for a portion of time. And that has happened at a time where plan sponsors are saying, you know what, maybe that's not such a bad thing for retirees to keep the assets in their plan. It gives me more assets. It might give me better pricing power, economies of scale. So I'm finding that plan sponsors are more interested, or more open, I should say, to encouraging retirees to keep assets in the plan. Now, the other reality, and this is something that I'm sure you're navigating with your medical benefits, but we need employees to be financially ready to retire at a healthy age. And to do that, having an income source is an important stool to that leg to that stool. In fact, the cost of a 1-year delay in retirement, and this was noted by a Prudential study, was nearly $50,000 by the time you factor in additional medical costs for your medical benefits, and perhaps an unengaged workforce who is at work because they have to be, not because they want to be. So we're seeing more and more plan sponsor demand. So participants want it, plan sponsors are thinking about it, but up until recently, listen, if you're a signer or you're a fiduciary on retirement committee, there's personal liability there. So I'm not throwing investment in an investment menu without making sure that I have the proper diligence process, but more importantly, what safe harbors is the DOL giving us for offering this type of investment, which looks and feels very different than the conversation around choosing a stock fund, a bond fund, or even a target date fund, which admittedly is more complicated than traditional stocks and bonds. So that gets us to this third error, the Secure Act error, where the government is really trying to promote and collaborate with the private sector to offer retirement plans. And in fact, they're doing just that. Many states have mandates for retirement plans. I'm in New York, and there's a mandate if you have more than 10 employees, you're going to be mandated to offer a plan or give access to a state-sponsored plan. But Secure Act 2.0 is using, instead of the stick approach that many of the states are taking, from a federal perspective, they're using the carrot. And they're offering incentives with tax breaks and some more lenient filing requirements to really encourage those smaller companies that don't offer a plan to entice them to do that, so that we can take the 66% of private employees who have access to a retirement plan today and get that even higher. And as part of the earlier requirements here, so in 2012, that's when fee disclosure became an issue. And you might have noticed, if you haven't benchmarked your plan in the last 10 years or so, even the last 5 years, you're going to be pleasantly surprised, because fees have been coming down from a record-keeping perspective. And in part, that's because the DOL has forced the industry and sponsors to shine a light on that. So all plans receive what they call a 408(b)(2) fee disclosure. And that's where it should outline all of the fees that are associated with the plan that your participants pay and who's getting compensated off of that. Now, in 2013, there was a push to offer lifetime income But instead of this being a product that there were safe harbors for, it was more language on a statement. So today, you and your employees have some lifetime income support, certainly more than you had 10 or 15 years ago. You go to your statement, your balance is translated into a monthly income stream. And why is that? It's because of the first slide I showed, the fact that the average worker thinks that they can draw 10% off a $500,000 portfolio. That's just not sustainable. So we want to put a reality check really for participants to understand, while this may look like you have a lot of money, in retirement, it's going to give you X amount of dollars a month, if we project that you live for 20 or 25 years. Now, what has accelerated the interest in this topic is Secure Act 2.0, where the Department of Labor is offering safe harbors for the inclusion of a product that guarantees income or that provides some income support. So that's kind of setting the stage. Now let's talk about, and what I love about this section, quite frankly, is that you might be wearing your HR or finance hat and thinking about your employees, but keep your ears open, because I'm confident that some of this is going to resonate with you individually as a pre-retiree or someone who's saving for their future. So what I call this section, the 3 R's: reframing retirement risks. A lot of people assume that your number one risk in retirement is stock risk. Like when I think of the word risk, I think the tendency is to think about market risk and volatility risk. And that is very important, needs to be considered. But I think you got to flip the question around and say, the risk to what? Is it the risk to you being able to have an income stream through your working years? Really, for you not to run out of money. What are the risks to you running out of money? This is a very important question. And it's questions that pre-retirees are asking themselves. Am I going to be able to maintain my lifestyle in retirement? Where am I covering my expenses from? How should I be investing? Can I retire now or should I wait? Will my money last? So when we think about financial pressure and financial stress, these are big topics. And employees are looking for support through your benefits to figure out, where am I? How am I doing? What does my financial checkup look like? I mentioned before the phrase financial wellness. When I share this information, many people are surprised, but it makes sense. If you go to WebMD, you can actually find information about financial health. So think about that. It's a medical website where you can find information about financial support. And of course, the reason for that is our wellness is intertwined. Our mental health, our physical health, our financial health. And the Columbia School of Medicine recently did a study where they discovered that there were physical consequences to feeling helpless from a financial perspective. And that to get better physically, more physically fit and less stress on the body, the finances, not all of these questions need to be solved, but there needs to be a plan. So you need to feel like you're making progress. Listen, we're not solving everyone's financial woes. That's not a realistic goal. But do I know what my next right decision is? Do I know about the options that can help me make progress? Mentally, that really helps put people in a better state to make smart decisions. So there are 6 key risks to retirement. I talked about market risk. The risk of the market is that that you're over allocated to stocks, and the stock market goes through a bear market or has a significant decline. Longevity risk is the risk that we are living longer. And you could actually flip the word risk and say opportunity, right? The fact that we are all living longer gives us the opportunity to have a retirement experience that is fulfilling to you, but it's expensive to live longer, right? Because you need to fund your expenses for that much longer. So think about it. And we're going to see some stats about that longevity risk. But if it costs you $100,000 a year to live and you live an extra 5 years, that's $500,000. So we'll talk about how to manage that. Inflation risk. Inflation seems to be the word of the year. That right next to the word tariff is a hot topic. We are not going to attempt to address all of those issues today. But whether it's tariffs or something else, inflation is a risk that is here and is here to stay. Inflation could be low, inflation could be high, but inflation at its core means it's going to cost you more in the future to have the same lifestyle you have today. And the takeaway to that is you need to have your assets grow to hedge your inflation risk. Interest rate risk. So if you're over allocated to, or if you're allocated to conservative investments and interest rates go down, you'll have less of a return on your capital. I'll tell you just a comment on the current interest rate environment. Savers are finally getting rewarded. 5 years ago, if you were to put money in cash, you're getting literally 0% on your dollars. Think about during the COVID pandemic. Today, interest rates are higher and you can invest in a money market that is yielding 4%. Well, there is a parallel between interest rates and these guaranteed income options. And I feel like this discussion is the right place at the right time. If interest rates were at near zero, the cost of a guaranteed income option, the cost of something that looks and feels or actually is an annuity would be astronomically high. But now that interest rates are a little more attractive, annuity rates are looking more attractive. And personally, I mentioned at the outset that, annuities get a bad rap because there's a connotation with a lack of transparency and fees. And I'll admit that I hedge against that. That I have more concerns around throwing a guaranteed income product into a plan than I'm ready to jump in with 2 feet ahead. But I can see the benefits. And I think through a thoughtful process, there's going to be a happy medium here. But there's some important considerations to take into account. But I am now more than ever working with investors and talking about something that looks and feels like an annuity, where I'd say 10 or 15 years ago, I was not doing that. So the interest rate environment is attractive. Withdrawal rate risk. We're going to see a visual about that in just a moment. This is the risk that you take out too much money. You take out that 10 or 7% and you're running out of money earlier than you need to, and just wrapping it up. Legacy risk. So if you choose to lock your money up in an annuity or a guaranteed income product, you might have less in the form of assets to give to heirs. For some people, that's a concern. For others, it's not. I'd say the risks, everything other than legacy risk is something that every investor faces today. So a word on longevity. I'm sure you've seen numbers like this over the course of your travels. The average male age 65 has a 50% chance of living till age 87. That's 22 years of retirement he needs to fund if he retires at 65, and a 25% chance of getting to age 93. A female, 50% chance of living to age 89, 25% of surviving to age 25. That's 30 years of retirement income you need to fund. And then if you have a married couple that are both the age of 65, the chances of one spouse living past age 90 is very high. So that has a lot of implications for income. We're going to talk in a minute. It's going to inform how you take Social Security. It might inform whether or not you choose to work part-time in retirement. So those are non-investment related factors that you have to help your progress. And then, of course, there's the investment related ones we'll talk about. Inflation risk is real. Let me just put it that way. So over the course of the last 50 years, the average inflation rate has been about 3%. Up until the last few years, in our more recent history, it was closer to 2. And of course, since 2022, inflation has been trending higher. In any event, whether it's 2, 3, 4, or another number, $50,000 today would be a fraction of that 25 years from now. So if you're 65 today and you need $50,000, and you live till age 90, that 50,000 in income is going to buy you 2/3 of what it used to buy you. So think about it that way. So that 2 or 3, 4% inflation is almost a bogey. It's the hurdle rate that your investment needs to earn to just keep you on pace with maintaining that current lifestyle. Asset allocation and the amount of risk that you take in your portfolio, that's simply the mix between growth assets and non-growth assets, stocks and bonds. That is going to inform your rate of return over time. But there is a parallel. The more risk you take, the more return you can expect. But that coupled with when you start to withdraw from the portfolio can either be an advantage or can be a risk. So if we're saying that inflation is at 3%, knowing that there's going to be aspects of your spending that's going to be higher than that. Healthcare costs is running at over 5%. So let's say between 3 or 4% inflation, if you're invested in a conservative portfolio, 20% stock, maybe the average rate of return, so over the last 100 years had been just under 6%, there's going to be periods where it's much lower than that. There might be periods where it's higher, but you could see here that the net rate of return, another way to say it is the real rate of return after inflation is only 2.75%. So you need a little bit of growth to help you balance that inflation risk. Withdrawal rate risk, this shows us here, and I know the slide is busy, but the takeaway here is asking yourself, what is a reasonable withdrawal rate of my portfolio? And historically, we've said about 5% is a reasonable withdrawal rate. So, back to my $500,000 initial balance, that means you can take out $25,000 a year. And oh, by the way, if you've been saving pre-tax, every dollar you take out of an IRA is going to get taxed. So your net withdrawal number is going to be lower than that. In today's environment, we're really guiding people to think more about, particularly if you're interested in leaving some type of, maybe not your entire principal balance, but some form of your assets to heirs, 4% being a more reasonable rate of return. But if you start out early at 10, 9, 8%, I mean, over this time period here, you got through 10 years, 15 years. So this is an important consideration to make. And I say this to participants when we talk about retirement income planning. I am sure that the record keeper that you use has some type of retirement income planning tool. And some of them are really sophisticated. You could put in outside assets, other income sources, and it can get pretty complicated pretty quickly. So I like a barbell approach. So let's go through that in-depth analysis. But let's also do a back of the envelope calculation. Okay, apply 4% to the amount that you've saved. That's the amount you can spend, give or take. And if you're years away from retirement, that base is going to grow through deposits and portfolio growth. So maybe 4% of a lower denominator is going to get you where you need to be. But that's a good just gut check, so to speak, of if you're on the right path. And if I'm at a risk of losing you, just hang in with me. This is one financial planning concept that can be complicated, but it is so important. Sequence of return risk. So this is the order in which you're receiving your returns. So if you are not saving and you are not spending, it doesn't matter if you start out with high returns and end with lower returns, if you have the same return each and every year, or if you start out in a bear market and end in a bull market. No impact. However, when there are cash outflows and also inflows, this becomes materially important. And unfortunately, this is a risk. We don't have a crystal ball. The example I give for those of us who have the war wounds of investing during the Great Recession, so during the time period of 2008 and 2009, I think about that retiree that said sayonara to his colleagues or her colleagues in, let's say, May of 2007. They're feeling pretty good because the markets had been on a tear. Their balance is higher than it's ever been. It's a high watermark. So they say, okay, now I feel comfortable. I'm going to retire. maybe they let their portfolio run and they've got more stock than they started with. So, maybe it's a 70 or 80% stock portfolio. But they need to draw an income because their paycheck is they're no longer getting W-2 income. They need to take money off the portfolio. So they are selling securities to live, really, to take a distribution from their IRA. Okay, income's 2008, and we have almost a 50% decline in the S&P 500. So this is the double whammy. The market sells off dramatically, and you're selling shares, which forgoes the opportunity for those shares to regain growth when the market rebounded. So market risk and volatility when you're an investor, when you're in the accumulation stage, this volatility can work in your favor, right? Because you're contributing the same dollar amount each and every paycheck, you're buying more shares, and you've got more that's ultimately available to rebound to you. But when you switch phases and you go from accumulation to decumulation, then it really matters the price of each share as you're generating an income stream. I'll give you an example. In today's environment, you're probably pretty happy with the performance in your account. Most participants are. We get very few calls from participants about performance this year because regardless of whether their fund outperformed or underperformed, stocks are doing well. So their portfolio, if they're allocated to that, is doing well. And I'm telling people, mentally take a 10% haircut off of what you're seeing in your statement, because at some point you're going to see that. And if you are within a few years of starting to spend from the portfolio, or you're in retirement, it's a great idea to start raising more money today. So trim, rebalance, and build those cash reserves. So these are risks. Now, they're risks that we can't control. So what are the things we could do to hedge? And what does the future hold? So we went from a pension environment to a 401k environment where you can actually grow your assets with stocks. Now we have target retirement date funds, which are really perfect. Well, I don't want to say perfect, but they could be a great option for those who need guidance and don't feel comfortable making the investment decisions. So the next horizon is really this in-plan retirement income option. And retirement income can come in one of a few different flavors. So what has been around for a very long time has been Social Security and your ability to take a set withdrawal from your account. So that exists today. There are two additional options that are starting to get introduced: a managed payout option, which is not guaranteed. It's where the investment vehicle is structured to give you, let's say, a 5% payout each year. And then the slice of the pie that's sliced out, lifetime income solutions. This is a guarantee. This is saying, okay, you give me X number of dollars, and an insurance company or the investment provider is going to promise to pay you a certain dollar amount per year for your lifetime. And there's a whole bunch of bells and whistles and caveats associated with this asset class right here. Let me start with Social Security, because investment decisions and financial decisions should not be made in a silo. I think an underappreciated fact of Social Security is that the longer you wait to take it, the more you're going to get in retirement. So there's actually a 70% higher Social Security amount if you wait till age 70 versus if you take it at early retirement at age 62, 70% higher. However, there's got to be some education gap here, because 30% of American workers have been electing to actually not even wait till their full retirement age of 66 or 67, let alone there's only 10% who wait till age 70 to maximize that monthly payment. So you can make a pretty strong argument, particularly if you have longevity on your side. And again, every individual is different, unique circumstances, warrants conversations. But if you're relatively healthy and you're looking forward to some longevity in retirement, it may make sense to, even if you're retiring, let's say at age 65, maybe still waiting till age 70 to take those benefits. So incomes, your 401k, your 403b, it's something that you're going to tap to access to bridge that gap between your retirement and Social Security age. This is one of those slides that I said you're going to want to reference if this is a conversation you're going to have with your committee. And again, I'm going to share these slides with you. I'm outlining, and I know it's dense, 3 different investment options. A non-guaranteed investment option, a guaranteed solution more typical to an annuity, and something that's gaining popularity, this hybrid income solution, part asset, part income stream. If we start with the non-guaranteed solutions, they'll generate an income stream, but there's no guarantee of the specific dollar amount because it's built based on a percentage of assets. So I'm going to pay you out 5% or 6%. What risk does it cover? Well, you don't have to, if you're only getting 5% and you're spending that, it's dealing with your withdrawal rate risk. Because that 5% is tied to a portfolio that has the opportunity to grow, you have the opportunity to hedge that inflation risk. And because you're not completely handing over your assets to someone else, you have the potential to have a legacy at the end. So the risks that they do not address, longevity risk, it can work if the markets do well. If it doesn't do well, you could run out of money. This is not a guaranteed income stream for life, hence the non-guaranteed name. It does not address market risk or interest rate risk. The guaranteed option, these are investments offered through an insurance company. And the goal is to provide a steady and predictable stream of income for the insured. So this is the equivalent of, let's say, the traditional annuity that you might be familiar with. And annuities come in all different shapes and sizes, and we'll talk about that. But the risk that a guaranteed solution addresses is longevity risk. The insurance company is promising to pay you a certain dollar amount for the rest of your life, even if you live, till age 100. You no longer have market risk because you're not exposed to the market. Interest rate risk, you've locked in your interest rate with the annuity rate, and withdrawal rate risk, you have that same dollar amount. So this guaranteed option does not hedge against inflation. There might be some riders that you can add to it, but doesn't hedge against inflation. And it also doesn't address legacy. You're handing over a chunk of assets, you're going to get this guaranteed income stream, but there's not going to be a chunk of a pot, so to speak, at the end of the rainbow for a legacy. The hybrid retirement income solutions look and feel like those guaranteed solutions, but it's a combination of an insurance-based product and accumulated assets in some type of retirement investment account. So that's the spectrum. That's what the offerings look like today at a high level. Now, the advent of target retirement date funds, I mentioned before how automatic enrollment has become something that's really been embraced. So if you're automatically enrolled, that begs the question, how are you going to invest? So you're going to default into an investment, and target date funds have been a popular choice. There's also managed accounts, which is another option. And more of these, what we call QDIA, those qualified default investment alternatives, are trying to figure out how can we offer an option that has an income component to it. And a lot of whoever can solve for this is gonna do very well. And there's some options today, but I really think that we are in the very, very, very early innings of a game where the end goal is to get an investment that meets the needs of your participants. And at the end of the day, just like with any investment, this comes with it a series of trade-offs. And I'll just digress for a second. When employees were polled on this, they say they want a guarantee, they want an inflation hedge, they want the ability to access like if they needed $25,000 more than they thought in a given year, they want that ability to tag that. They want it all. Well, that's kind of panacea. There are going to be trade-offs of different products. So from now I'm asking you to put on your fiduciary hat. So for the last, 20 minutes or so, you had some parallel paths between thinking about how could this help my employee and how could this conversation help me as an investor and a saver. Now, from a fiduciary perspective, in order to take advantage of the safe harbors outlined to you, you need to follow a very specific process for identifying if this is appropriate for your employees. Now, the first step is to think about, how are you going to even judge these investment options? And this is trigger 1.0. This is going to require an update to your investment policy statement. Just like your investment policy statement had to be updated for the criteria for evaluating a target date fund, because that's unique compared to traditional stocks and bonds, I could see this being another addendum to your investment policy about how you're going to evaluate income options. But even before we get there, and this is where we're going to wrap up, is thinking about your employee demographic. Are your employees keeping their assets in the plan when they retire? If so, maybe that kind of tilts you in the corner of exploring this. Are they conservative? Are they concerned about market volatility, outliving your savings? I do want to make a point, and then we'll go through this process here. The interest in guaranteed income is not an income issue. This is not just for those who have low to mid income and they're concerned about running out of money. There is a psychological benefit to getting a paycheck. I mean, I've worked with individuals and families where like running out of money was 100% not a concern of theirs, but they still like the permanence and definition of getting a payment from an insurer from an annuity each and every month. So this is not just about those who don't have enough, like that scarcity mentality. It's also psychologically, how can I enjoy my retirement years even more? For those who are interested, I do have some sample language for an investment policy statement. And you can follow up after the conversation, after today's program, when I send the email, if you'd like to see that. So once the investment policy is in place, you've got to first identify what are the options available with my current record keeper. And that's not that you can't stop your search there, but this is literally changing like quarter to quarter in terms of what can be available. Now, there are complexities with the insurance companies offering this. And the complexities is that annuities are generally not portable. So we're looking for understanding what the portability and fees are. And then you're going through an objective review, and I'm going to get to the criteria there in a minute. You want to make sure that you've documented any conversations around this in meeting minutes, that you've talked about the risks and the benefits. And if you're this is coming from a recommendation off of an advisor, that's also been documented. This is not a one and done conversation. This is part of the ongoing review. So once this decision is made, this should be part of the evaluation process that you have. This is the second slide that I think the slide that had the 6 risks of retirement, I think is very important. I showed you the guaranteed, non-guaranteed. This is the third slide that you might want to refer back to. This gives you a sample set of criteria for evaluating income options. You want to understand what the fees are involved. What are the payment guarantees of the company? Is there any type of protection, ability to access assets above and beyond that monthly payment? What is the liquidity? Is there a death benefit? Some options can offer that. Do you have the ability to make additional contributions? What is the participant communication approach? When you leave the company, if you've been adding to this type of investment, if you want to take your money elsewhere, what is the rollover options? Has this insurance company been in the business? What's their track record? If there's a tie to the markets, has their performance been? Now, I have to tell you, and I know I'm 50 minutes in, this is a dense conversation. My goal today is awareness. So you should know this is out there. You should be talking about it at your committee. You don't need to be an expert. So don't let this level of detail overwhelm you. This is where you're going to tap your record keepers, your advisors, to guide you on a process to evaluate, does this make sense? I will tell you, for client conversations that my team and I are having, this is a topic very much of interest, but many are choosing to slow down and wait, because the products that are going to be available in 12 months are going to offer more options than available today. But this is something that it is a process to consider, and you want to think about that. For the reasons I've mentioned, but I'll just tie it in a bow right here. Challenges to retirement income is the availability. So depending on the record keeper that you have, products may or may not be available. You can push providers to expand their offering, and this is where you should lean in. Like from an advisor standpoint, we're always talking to record keepers about product availability. Portability, the ability to transfer. What you don't want to do is, let's say you've got ABC record keeper, your choice of adding an income option locks you in to always stay with that record keeper, right? You need that portability function. Expense, there is a perception that this is too expensive. Now that's a relative comment. There is going to be an expense. You're getting a benefit. So, cost versus value is an important consideration. However, through the vehicle of a qualified retirement plan where there's economies of scale, you should expect institutional pricing. So the pricing for an income product should be more attractive within a plan than if an individual went to an insurance company on their own. And this is honestly what gets me is the complexity feature. Now, I have been to retirement income symposiums. I've joined focus groups of advisors that are talking through these options. And I find that those providers that are looking to sell the product are focusing on the simplicity. From wearing your participant hat, what is more simple than understanding I'm going to get a paycheck of $4,000 a month for the rest of my life? Okay, yes, but what are you giving up for that? And what if you needed more than $4,000? And oh, by the way, to get $4,000 a month, which is $48,000 a year, you need to have saved a significant amount of money. So from a fiduciary perspective, you cannot make this a simple conversation. It's just not possible. When you ultimately communicate to participants, they are really going to need to understand the trade-offs, which is why we're encouraging the opportunity, or even perhaps the requirement, for someone to have a conversation one-on-one with someone before they opt into this type of investment. Now, the reality is there is demand. 84% of savers want some retirement income solutions built into their plan. This is something that is attractive. However, just like with the start of convincing someone that they should save in the 401k, this is incremental education about the options and the trade-offs there. So as I'm going to recap here, there is, from a today perspective, your takeaway, I'd look at your statement and look at that income projection. I'd ask your providers, what tools do you have available to help my employees move from thinking about, okay, how much do I have in my account, to how much does that amount translate into income? And that can come in the form of planning tools. And then for now and in the future, thinking about what products are available to you that you would want to offer. What are the pros and cons of that? If you have questions, you could throw it into the Q&A box through the Zoom link, and I'd be happy to answer that. But ultimately, this is a topic that is at the cutting edge of retirement plan education. I want you to know that we're on top of it, and a lot of your providers are engaged in this conversation. We do have additional resources, so yes, I'm going to provide the slides, but if your committee is further along in evaluating this, I found that this is a very nice parallel. If you had a pension, maybe that you're freezing or terminating, turning on an income option in the 401k is a nice way to ease that transition. I've seen some plan sponsors certainly do that as well. I do see a question around evaluating insurance companies. Yeah, so this is something that I would suggest as a committee, you don't want to do this alone, right? So if you're looking to add an option where you are choosing an insurance company, that's where your IPS is going to come into play. And I could share some criteria for evaluating the insurance company. You should know that the insurance industry is highly, highly regulated. Okay, so it's not as if you're going to any company that's throwing up a shingle down the street to hire them as the insurance company. You're going to hire a company that's been rated, that is following the NAIC rules. Insurance companies are also regulated from a state perspective. So that's an additional nuance depending on where your plan is domiciled. But yes, insurance provider review is important. Now, this is on, if there's a spectrum of retirement income solutions, this is certainly the going with the product is on the right side. So now I'm coming back. Thank you for joining. I hope you have learned something. But what you could do today when it comes to retirement income is you could be speaking in those terms, like translating, moving away from assets and account balance to income stream, and encouraging your employees to think about how much you're going to need in retirement. Maybe when you had a paycheck, you didn't have to closely monitor those dollars. And then what are the tools available to you within the record keeping platform? Are there any options that are enhancements to an existing target date fund that you offer that you can maybe tack on? And then I'd say on the right-hand side of the spectrum, which is both feet into the pool, so to speak, is where you're actually engaging with an insurance company to offer an annuity type product. So I know that this is complicated. I appreciate you spending a time out of your day to learn about this. And I'm just excited about where this is going and the ability to reframe the conversations with employees. Your benefits are important. Your employees rely upon them, whether they fully appreciate them or not. Maybe we can educate them about all the tools and resources that they have available. So with that, I am sharing my information here. You can expect an email from me, but if you have individual questions, certainly please reach out, connect with me on LinkedIn. We can continue that conversation. So here we are, the last day of July. I hope you have a great rest of the summer, and we'll talk to you soon. Take care.